Ron will tell you a little bit more about his background himself in a moment, but I'll just let you know that the way we'll do our session today is by having you listen to Bron's presentation, watch the slides. If you have questions, you can chat them in using the chat box, and then we'll address all questions at the end. So, Bron, why don't you give a little introduction for yourself, and then we can get started.
Will do. Thanks, Jenny. Good afternoon, everybody. It's my pleasure to be joining you here for this introduction to why all managers need to understand finance. Yeah, I thought I'd start off just by giving you guys a little bit of background on myself. I do a lot of teaching for the Rutgers Executive Education Program, and my background is mainly in industry, although I do spend some time in the academic world, but I'd say I'm probably 95% practitioner and 5% academic. I believe the academic side is only useful if it actually really helps you make better business decisions in the real world. So I try and spend most of my time in the real world and not in the ivory towers of academia. I'm actually a serial entrepreneur, so I've spent just about my entire career as an entrepreneur. I've been involved with a total of about a dozen startups. Some were very successful, others not so much. Currently, I spend my time primarily with 3 companies. One is as founder and chairman of a company called Rainbow Direct, which for those of you who've had kids, you may be familiar with our products. We sell Rainbow Play Systems, which are the big redwood swing sets for residential use. I'm also a principal in a firm called Partners to Market. We are a consultancy specializing in valuation and training, but really valuation is where we spend most of our time, and we like valuing, well, just about anything from businesses to buildings to ships to, you know, if you name it. We can value it. Usually the more difficult, the more interested we are in on it. So we spend a lot of time valuing intellectual property patent portfolios and doing, you know, pre-revenue type companies and things of that nature, which are sometimes a little trickier to value. And I am also the CFO and co-founder of a company called RST Automation. We are in that firm developing automation systems for hospitals, specifically for the sterile processing department of hospitals. And we've just brought our first product to market here and are starting to get some traction, so I'm real happy about that. I am an adjunct professor here at Rutgers, so I teach in both the finance department and the management and global business department. The management and global business department is where the entrepreneurship resides at Rutgers Business School. I spent a few years as an entrepreneur in residence here with Rutgers at an institute called BEST, which stands for Business Engineering, Science, and Technology. And our mandate there was to help the university commercialize all its intellectual property. So Rutgers is, as you may or may not know, a big research institution, and they come up with some great ideas every now and then, and those ideas get patented by an office called the Tech Transfer Office, which just about every research university has. And my job was to just sort of help them sift through all these patents and determine what had some commercial potential and what didn't. And if it had commercial potential, we would actually hook the patents up with teams of MBA students and teach them how to write business plans, go-to-market plans around these technologies, and then ultimately, if they wanted to, launch them. And a few students after graduation did, in fact, launch these companies, and we helped them form the management teams and get funded and do some exciting stuff. So enjoyed my time there. Education-wise, I have executive MBAs from Columbia Business School and London Business School, so I spent a few years back and forth across the pond. My undergraduate degree was in finance at Rutgers, so Rutgers holds a near and dear place in my heart as an alumni. All right, what are we going to be talking about here today? Well, I wanted to first and foremost give you an understanding of why finance is important regardless of what your role is within your firm. And I also really wanted to provide you with some insight into what you will learn if you choose to take the Rutgers Executive Education Finance Essentials program. So those are really our 2 goals here for today. A quick snapshot of what we'll be covering. So I wanted to start off just talking to you a little bit about what finance is. It's a term that's often used, but I want to make sure we all have sort of the same base level here as we go further into our discussion. So we'll first talk a little bit about what exactly finance is, and then we'll talk about what finance can do for you and why it's so important to understand it regardless of your role. So we'll talk about understanding the language of business, which is certainly something finance can help us do. Some tools for evaluating performance that finance gives us. We'll talk about the differences between profit and cash flow, which is a very important concept to understand. We'll also talk about what some of the key decision-making tools in business are, and these are primarily finance tools that really allow you to put some hard numbers around your business decisions. And we'll also talk about resource allocation, which is using those decision-making tools to actually allocate resources within the organization, which is ultimately the end goal. So that's a little bit of roadmap of what we'll be covering here this afternoon. So first off, what is finance? Well, finance really focuses on determining value. And in order to determine value, you really need to spend some time thinking about the future. Now, that's not to say you ignore the past, because the past should serve as a useful guide, but we don't want to make the mistake either of assuming that the future will continue to look like the past. There was a lot of investors back during the Great Recession here that made that assumption, and as they found out in 2008 and 2009, the future did not look much like the past. So, accountants, now there's a bit of a difference here between finance and accounting. Accountants tend to focus more on recording the financial statements, or capturing the past and presenting it to executives or to investors, to outsiders. So they're really concerned with capturing an accurate record of what's transpired within the firm, and then finance sort of picks up from that, uses that information as a guide, also uses, of course, that information to evaluate the performance of the firm, and then starts to look to the future in the hopes of determining what holds the most value, and then deciding if that's something they want to pursue or not strategically. So the job of a firm's chief financial officer, or CFO, who is the highest ranking person in finance in the firm, is to manage the financial risks of the firm. And we'll talk a little bit about more what those risks are, but that is his or her core responsibility, is to manage the firm's financial risks. Now, financial institution. What exactly is a financial institution? This is a term you hear talked about in the media quite a bit. Firms we're all familiar with the names: Goldman Sachs, Merrill Lynch. These are all financial institutions, Bank of America. And I think the easiest way to think about financial institutions is to just think about a coin for a second. And if you think about that coin, think on the one side of the coin you have investors who have capital, who have money that they wish to invest. And on the other side of the coin are issuers, or users of that capital, or people who are seeking to put that capital to use, to employ the capital. And the coin is simply the medium where those two meet. And that coin we could call the financial institution. So really what financial institutions do is connect people who have money with people who need money. And of course they pocket themselves a nice commission usually in the process of doing so. But that's fundamentally their role, is to connect the providers of capital with the users of capital, and to structure the means by which that capital will be deployed, whether it be in the form of equity or debt, or some hybrid of the two. Now let's talk a little bit about who investors are for a minute. And for the purposes of finance, an investor is really anyone who's responsible for deploying capital, or anyone who makes what we call capital allocation decisions. So in that sense, we're all probably investors in our lives, hopefully. We all hopefully are investing in our retirement to some degree. But really the managers of a firm are very much the same as investors, right? They are making, the leaders of the firm are usually making capital allocation decisions, to deciding where to direct the firm's resources to, hopefully find the most profitable growth possible for the firm. At the end of the day, these decisions are usually made by the senior management team, and ultimately the CEO is responsible for making these capital allocation decisions. If it's a publicly traded company, then the board of directors may need to also approve that. But in this sense, really the senior management and essentially all of us on this webinar are investors. We all are responsible for making capital allocation decisions, right, for deciding where to spend our money. Now, it begs the question a little bit, well, what do investors want, right? And this is really sort of towards the core of finance here. And what investors are looking for is the highest risk-adjusted return possible. And those two words are really the key here, right? It's not just the highest return possible, it's the highest risk-adjusted return possible. And that's a crucial difference, because if I was to come to you all and say, hey, I've got a wonderful investment here, it returns 40% a year, would you like to invest with me? Well, as attractive as that may sound, I really haven't given you enough information to make that decision yet. What you don't understand is of course, what the risk profile of that investment is, right? How do I go about earning that 40% return? If I was, for example, somehow able to earn that 40% return here in a by buying treasury bills, right, government debt that's very safe and very secure. If I was somehow able to turn those very safe instruments into a 40% return, well, everybody I'm sure would be sort of lining up to give me their money. I'd probably have actually a line all the way around the block. If, on the other hand, I was generating that 40% return by taking your money and going down to the Meadowlands and betting on Betty Blue in the fifth, you may feel that you weren't being adequately compensated for the risks incurred in that investment strategy. So, so the point is that it's very important to there's two things you need to understand. One is, yes, what returns are possible, right, if I put my money here, and the other is what's the risk associated with that. And those two form a sort of inseparable link, right? In the world of finance, in the world of business, there is no risk or there is no return without risk. And of course, the greater the risk, the greater the return better be. Otherwise, there's no incentive for anybody to take that risk. So yeah, at the end of the day, what investors are really looking for is the highest return on their money given their risk, given their risk profile. And some investors are willing to take on more risk. Others are comfortable with less risk. So they're looking to get the highest return for whatever amount of money or whatever amount of risk it is they're willing to take. And this is really what finance does. It sort of trains you to think like an investor in a very disciplined way. Now, the finance also deals with a lot of the concerns, the general concerns of the firm. So when we talk about we talk about cash flow, right? We talk about in finance sources of cash and uses of cash, right? Understanding where the money in the business is coming from, understanding where it's going, right? And we'll identify, what the different uses of cash are within the business and what the different sources of cash are within the business. Uses of cash are things like operating expenses, right? Just paying your general utilities and payroll and insurance costs. But there's also uses of cash in financing your balance sheet, right? And investing in what's called capital expenditures or investments in plant, property, and equipment, right? Those long-lived assets. There's also uses of cash, investing in inventory, right? Increasing the amount of inventory the firm has. Also increasing your accounts receivable, the amount of money that you're owed by your customers. That's also, as you come to learn, a use of cash. And also actually kind of a zero interest rate loan to your customers too, which is something that's also important to be aware of. But sources of cash, there's really, primarily three sources of cash. There's either money comes into the firm in the form of equity and debt or in retained profits, and learn a lot more about how those different sources become available to the firm. Also, we'll have a very sort of MBA level discussion of risk, right? Really understanding what the fundamental drivers of risks are to the firm, and broadly it can be broken down into business and financial risk. And business risk is dependent on things like operating leverage and variability in earnings or variability in revenues. Financial risk has a lot to do with debt, but there's also some other factors that are important there. So it's important to really understand the different sources of risk and to have a comprehensive way to view the overall risk of the firm, because that will help guide proper decisions. So also something the firm is usually always concerned about is generating an adequate return for its owners, right? For its shareholders, for its owners. If it doesn't and returns are too low, then ultimately owners sooner or later will move their money elsewhere, right? So if you're not generating enough of a return for me, given of course the risk that I see associated with the firm, then ultimately after too long of that I will move my money elsewhere. If you're a publicly traded company, that's when you see the stock price start to decline, right? And that is literally owners selling their shares and moving their money somewhere else. So, so that's another concept that we explore in some depth. All right, so I want to talk to you a little bit about financial statements, okay? And this financial statements are, of course, a key component of finance. And financial statements really are at the heart of sort of understanding the language of business, right? And if you don't know how to read financial statements, you're really fundamentally at a disadvantage and really handicapped, I think, in being able to move or to advance in your career to higher level positions, because you really need to be able to speak and understand the language of business to excel in it. So we go into some depth about what the key financial statements are. The three key financial statements for firms are the balance sheet, income statement, and cash flow statement. And here I sort of like to use the analogy of a fruit tree, or of a fruit-bearing tree when we talk about these financial statements. And in that analogy, you come to learn that the balance sheet really is sort of like the trunk and the root systems of that tree, right? It really provides the foundation for the fruit, which is really measured by the income statement. So the business's assets or its balance sheet hopefully generate some fruit, right, some harvest from the year's activities. And the cash flow statement it can be viewed as sort of the water to the tree, right? Just like a plant or a tree can't live long without water, well, a business can't survive long without cash flow. So specifically, we can look at each of these in a little more detail. You'll learn that the balance sheet really provides us with an overview of the firm's financial condition. Okay, and it's really a snapshot of sort of all the stuff that the business owns, and who are the claim to that stuff. And each of these statements, as you see, sort of has an overriding equation to it, right, or something that governs it. So for the balance sheet, that equation is the fact that assets have to equal liabilities plus owner's equity. The income statement, of course, answers that age-old question, right? Do we make any money, which is usually of some interest. There, the equation is revenues minus expenses equals earnings or profit. So, if you tally up all the money the firm took in the year, or the quarter, or the month, or whatever time frame it is you're looking at, subtract out all the firm's expenses during that time. Hopefully, you're left over with net income, or you may have suffered a net loss. So either earnings or losses there at the end. The cash flow statement tells us where the money is coming from and where's it going. And there we have this equation: sources of cash minus uses of cash equals the net change in cash. And really what the cash flow statement tells us is how our bank account got from X dollars at the beginning of the year to Y dollars at the end of the year. It sort of reconciles that change in cash and shows exactly where the money came in from and where it went to. Now, if you're a financial professional, you'll probably spend most of your time, or for example, you're in maybe the credit department of the firm, you'll probably spend a lot of time looking at a firm's balance sheet, managing current assets and current liabilities, structuring loans, dealing with accounts receivable and accounts payable, and all these inventory. These are sort of what the firm spends a lot of time managing. If you're an operating manager, if you're in charge of maybe a division or a product line for the firm, then you'll probably spend a lot of time managing the income statement of that division or product line. So keeping a close eye on you're trying to grow the revenue line, trying to increase your margins, and of course at the same time trying to keep your expenses as low as possible to hopefully earn a nice profit at the end of the period. You can move, so once you sort of understand the language of business, or how to read and interpret those three financial statements, we can then move on to financial statement analysis, which is really then taking those financial statements and starting to really measure a firm's performance. And that's what financial statement analysis is all about. So in financial statement analysis, again, once we can read that sort of language of business, we can use ratio analysis to make some really interesting insights regarding a firm's profitability, its efficiency, what's called its leverage, and its liquidity. And really the goal here is to teach you how to apply ratio analysis to a firm's financial statements in order to gain insight into those four areas. And it will really, as you'll see, give us some insight into a firm's operations, into the capabilities of its management team, and also into really the competitive position of the firm. You'll then apply this knowledge to a real company's financial statements to evaluate its performance over time. And we'll see, we can think about things like, are we efficiently using our assets to create shareholder value? What does our firm do well, and where could we use improvement? And you can sort of look at these things both within the firm over time, so have things been improving or declining. You can also look at them, you can also compare the firm to its competitors and answer these same questions, right? How do we compare to our competitors? Are we more efficient or less efficient in different areas of the company? And in using this ratio analysis, there's really four areas that we dive into. So one is, which is the first item here, which is profitability. And in looking at profitability, we'll learn about things like return on equity, which is probably the most broadly used measure of performance. And we'll see how we can actually break down returns on equity using something called the DuPont analysis. We can really break return on equity into three drivers: the firm's profit margins, the firm's asset turnover, and the firm's financial leverage. Now, what are these? Well, the profit margin really talks about, right, is really the earnings squeezed out of each dollar of sales, right? So how much profit, how much earnings can the firm squeeze out of each dollar of sales. And of course, the higher this is, the better the firm is at translating sales into profits. Asset turnover, this is really a measure of the sales sort of generated for every dollar of assets employed, right? So, and again, much like profit margins, the higher this is, the more efficiently the firm's assets are being utilized, the more efficient the firm is operating. Financial leverage, this is really just a measure of the amount of equity used to finance the firm's assets. So that's really a measure of a firm's, or an indication of a firm's what we call capital structure. Right? And when we talk about capital structure, we're just talking about how the assets of the firm are financed. So how much debt relative to equity does the firm use to finance its assets? And financial leverage is a measure of that. But these are really the three key levers of firm performance. And anything, as you learn, anything you can do to increase these ratios will increase returns on equity. We also talk about gross margins, something called the price-to-earning ratio, or PE ratio. And again, this is just sort of a sampling of some of the ratios you'd be learning about. Talking about efficiency ratios, here we talk about things like asset turnover, inventory turnover, what's sometimes called days inventory, days receivable, days payable outstanding, another thing called return on assets, or ROA. So again, these ratios really give us insight into management, right? How efficiently, where is management doing a good job managing the business, and where are they doing a not so good job managing the business, and how good are we at managing our business relative to our peers, right? Relative to our competitors. So these ratios can all be used to give some insight into that. Leverage ratios, things like debt to assets, debt to equity, something called a coverage ratio. We can also talk about the market value leverage ratios. These are again referring to a firm's capital structure, and again are measures of how much debt versus equity is the firm using to finance its balance sheet. And as we talk about risk, you'll see that as the firm employs more debt, while that is good at generating higher returns, it also increases the riskiness of the firm, and to sort of learn about the pluses and minuses of that equation. Liquidity ratios are the fourth and final. Here we'll talk about things like the current ratio, something called the quick ratio, and you also learn why these are so important, because these types of these liquidity ratios really impact the amount of debt that the firm can have. And that's, of course, important whenever you're talking with bankers or creditors. They're always looking at these liquidity ratios along with some of those coverage ratios to determine if the firm is worthy of more credit or not. And it's important to understand, right, how they think about these things, so that if you're going to need some financing in the future here, you can ensure that you'll have access to that funding. Now, and these liquidity ratios really, this category here doesn't really have so much to do with performance as it does with survival. So liquidity ratios are sort of all about survival, and the reason why is that something else we really explore is this idea of profit versus cash flow. And when you're talking about how profitable a firm is, or what its net income was for the period, if we're looking at the firm's income statement, it's important to recognize that the net income, or the profits that the firm generates, really has nothing to do with how much cash the firm has available. So, for example, if your company generated or had the net income of last quarter or last year, or whatever time period you want to talk about, if the firm generated a profit of, say, $7 million in that time period, right? So if we're looking at their income statement, profits would be $7 million. Well, that doesn't necessarily mean that the firm has $7 million more in cash in its bank account. So these two are not tied together. So you can have a business that's very, very profitable, but maybe at the same time not liquid, right? Maybe out of money, and it's actually very, very easy, especially if you're in a rapidly growing company. It's very easy to quite literally grow yourself broke, and it's something that you need to be very careful of if you're the leader of a business, that you're not going to grow yourself broke. And to ensure you don't do that, you really need to understand the difference between net income and available cash flow. And the reason why is, that at the end of the day, look, profits are fine. We want to have the firm generate a lot of profit, generate a lot of net income, but at the end of the day, as you'll see, cash is really king, right? And it's you know, if the firm runs out of cash, it's sort of game over, right? Time to hit the reset button. So and that's one of the risks, right, that the CFO is always managing is, you know, one of those financial risks is that the firm runs out of money, right? So that's something that the CFO or you maybe as a senior leader of the firm needs to really be keeping an eye on, right? Making sure that you have enough money on hand to pay the bills, to meet your debt obligations, right? The problem is if you run out of cash, you know, right, you can't make payroll, so at some point sooner or later your employees will stop showing up. And even worse, if you have debt obligations and you can't, you know, meet those debt obligations, well, now all of a sudden you're really in jeopardy of losing the firm because those creditors are now in charge and they can come in and liquidate the firm's assets in order to get their money back. So so cash really is you know, really is king when it comes to operations. Let's see. So we'll also talk about, or learn a lot about some decision-making tools here in finance. And really these decision-making tools all come down to being able to quantify value, right? To really determine what the value of something is. And there's a lot of tools that we can add to your toolbox here that, by the way, I think not will, of course, help in your business career, but will also really help in your personal life too, because a lot of these same decisions, right? Making good business decisions and making sort of good personal financial decisions are, I think, really kind of two sides of the same coin too. So, so there's a lot here that I think will apply to your personal lives as well. But some of the tools that you'll learn about are things like the time value of money. So you learn, you know, why it is that you know, that money actually has a time value to it. And I think this is somewhat intuitive, right? We all, given the choice between, you know, getting $10,000 today or $10,000 a year from now, we would all, you know, either the money sooner than later. I think that's pretty intuitive, but there is actually a point where we become indifferent, right? So there is actually a specific time value to money that very much has to do with the amount of what interest rates are, right? So what interest you can earn on that money. But there's a time value to money, and we'll talk about, you know, what the present value of money in the future is, right? So if you offered to give me $10,000, say a year from now, well, there's a certain amount of money that I would be willing to take today that would be less than $10,000. That would make me, you know, that would be equivalent, right? I wouldn't care if you gave me, say, $9,850 today or $10,000 a year from now. And again, that to a large degree has to do with the interest rates in the market. Same thing with future value, right? We can talk about what, given a certain amount of money today and an interest rate, you learn what the future value of that money will be, you know, a year from now, 5 years from now, 10 years from now, right? However long you want to go. There's also a great little tool called the dividend growth model, which is one of the various kind of elegant formulas in finance, and finance isn't particularly known for elegant formulas, but this one is very simple and very elegant, and is really a useful tool. What I really love about it is that it gives you sort of quick back the envelope tool to make you know, to make some good business decisions, right? So and you know, and like Warren Buffett says, right, we often want to be approximately right and not precisely wrong. So this is a great you know, a great tool for that, and really helps you quickly size up an opportunity and determine if it's worth spending any more time pursuing or not. We'll also talk about what's called choosing the right discount rate or the right interest rate, right? So so a firm, right, when it's evaluating projects, has to figure out what rate of return it needs to earn, right? And that's covered in something that's called a weighted average cost of capital. So firms will often talk about, right, what is their weighted average cost of capital? This, by the way, is something that we're always looking to minimize. So the CFO particularly is always looking to find the cheapest sources of capital available to the firm to you know, create the lowest weighted average cost of capital, and that simply will allow the firm to you know, invest in more projects more profitably. There's also something that we'll touch on a little bit in the program, something called the capital asset pricing model, and this is really an underpinning of modern finance. What it really allows you to do is price out the required returns on equity. So if you're an owner of a business, right, what sort of return do you require given, of course, the risk of the firm? And so first we'll understand how we measure a firm's risk, and then we'll understand how we go about determining what rate of return we would require based on that level of risk. And again, it's, you know, we're looking to the markets here to really, you know, to really set those required rates of return based on what given interest rates are. And by the way, in finance, everything is kind of priced off of what's called the risk-free rate, which is usually like a 90-day Treasury bill, which is a Treasury bill's debt that the U.S. government issues. So depending on where that rate is, everything sort of gets priced off of that. We'll then also in the program talk about and really explore some tools for evaluating projects. Right, so these are tools like what's called net present value and internal rate of return. And what these tools allow you to do is given given a bucket or a whole list of projects, right? Usually the firm or most companies have more investment opportunities or more opportunities for growth than they have capital to fund. So one of the things that needs to be done is senior management needs to sit down and determine, okay, well, what is priority here, right? What projects are we going to invest in this year, and what are we going to defer till later? Well, they do that, in part strategically, right? So there's firms that there's obviously projects that have strategic importance. Hopefully those projects are also have what's called a positive net present value and a nice rate of return. But even if they didn't, they may still be done for strategic reasons. But then there's a whole suite of other projects that essentially need to be ranked, right, to determine what are the best and what are the worst. So net present value and internal rate of return are the tools you would use to evaluate those projects and to decide what it is you're going to pursue, near term, and what you may want to defer or not pursue at all. Sometimes there's projects that are actually, it turns out, value destroying, right? So even though it may look like an attractive project on the outset, once you take into account the time value of money and risk and some other things, it may very well turn out to be not a very good project to pursue. So that's, these are really important tools to understand. We'll also talk a bit about something called economic profit, and this is really being adopted by a lot of larger firms as really the ultimate measure of their performance, right? So, hey, it's great, firms recognize it's great that we're earning profits, that we're earning net income, but really at the end of the day, we've also got to account for, we've also got to be generating a return on all the capital we have tied up in the business. And if we're not generating, if our profits aren't great enough to generate an adequate return on that capital, then really we are not adding value economically, or in fact maybe destroying value. So a lot of larger corporations are really sort of starting to adapt return on invested capital as sort of their ultimate measure of performance. This is also sometimes called economic value added, EVA, or economic profit. These are all sort of names for the same thing, but really it's again sort of the ultimate measure of a firm's performance. So in short, if you're thinking about questions like, hey, should I, as a manager, should I invest in this new equipment, right? Should I purchase new equipment? If I am going to purchase it, right, should I buy or lease that equipment? Should I launch this new product, right? Should I expand my existing product line? Should I fund this R&D project, right? Or which R&D project should I fund? Usually there's, a lot of them competing for, right, the scarce resources. So which R&D projects do I fund? Should I invest in this IT project, right? Should I invest in general in project A, project B, or project C, right? Given that maybe I can only invest in one or two of them, which one or two of those three should I invest in, or perhaps none of them, right? Are any of them good investments or not? Most importantly, right, you want to know if you should take the lump sum or the annuity when you win the lottery. These are all questions that finance has the answer to. And really what it all comes down to is being able to make what we call capital allocation decisions or resource allocation decisions, right? So finance really is a tool is allowing you to make the right business decisions, right, in a very disciplined way. Okay, so at the end of the program sort of culminates with a live case study, and you're sort of in the classroom, you're given a live case, and you're basically put in the position of senior management and asked to decide between competing opportunities for growth, right? So basically you're the one running the company. You've got sort of two distinct paths you can take here next year, and you only have the capital to invest in one. So the question, of course, is on your shoulders: which one should it be? And And you'll see, right, as you sort of work through the case, and of course you're guided by your professor, who's in the room, of course, with you, guiding you, you'll see that you now have, right at the end of the course, you now have all the tools you need to make the right business decision. And that's, again, really the end goal of finance, is to allow you to make better business decisions. And by the way, I think it's also important here to distinguish between good decisions, right? So there's good business decisions and there's bad business decisions, and they're not dependent on what the outcome is, right? So it's important to distinguish between good business decisions that may have a bad outcome. Of course, we hope they have a good outcome, but they may very well have a bad outcome. That doesn't mean it was a bad decision. It may have still been a good decision, but just ended up with a bad outcome. Or there are, on the other hand, sometimes bad decisions that end up with good outcomes, and of course, bad decisions that end up with bad outcomes. But it's important to know which ones you're making, right? And if you're not sure which ones you're making, well, you will be by the end of this course. And it's important to also have a means by which to evaluate those you're managing, right? Because you don't want to be rewarding people for making, even though it may have had a good outcome, if they fundamentally made a bad business decision, that's not something we want to be rewarding them for. And of course, the other side of that is, if somebody made a good business decision, at the time, giving all the available information, it was a good business decision, but it happened to have a bad outcome. Well, that's also something we don't want to be punitive about either, right? There's always an element of timing and luck involved in all these business decisions. None of us have a crystal ball, but we do want to make sure that we are encouraging good decision making and that we have a tool set for doing so. So this is what the program ends up to equip you with, or sets out to equip you with. So if you'd like to learn more about this program, you can certainly sign up for it. Actually, I'll probably switch back over to Jenny here, and she can give you some more information about this component here. So Jenny, are you still with us?
I'm still here. Thank you very much, Bron, and thanks everybody for your attention. I hope that you feel like you learned a lot and understand why finance is really an overarching, I guess you can't really be overarching and foundational at the same time. That's what I was going to say. I think it's mixing my metaphors. But why finance really is so critical for people who are making any kinds of decisions, for a business, for an organization, for a product, for a brand, or for a team. I'd like to open the floor for any questions. You can chat them in if you have any questions, or I'm actually going to enable everybody's audio. We have a nice sized group, but I think small enough that if I turn off your audio, oh wait, I'm turning it off because there's a lot of background noise. All right, but if you have any questions, you can feel free to chat them in. And Bron, I'm just going to float one question out there that I was sent earlier, which has to do with, if you master these concepts of finance today, how likely are they to change in the future, or are these skills that really do carry you through, for quite a long time? How fluid is this?
Sure. Yeah. No. Great question. Yeah. These tools here have honestly probably not changed since they were created. So these are by far, and these are universal, right? So whether you're doing business in China or India or Europe or Australia or the U.S., if you're in charge of deploying capital or making decisions as far as where the money goes, these are the tools that are used to do that universally. And I, do not expect them to be changing anytime soon. They've sort of stood the test of time to date. Don't get me wrong. If there's something better that comes along, then by all means, I'm sure the markets would move that way. But these are really, when you talk about especially the project evaluation tools like NPV and IRR, they really are capturing, sort of all the necessary inputs. Might there be a simpler or more elegant way to do that? Yeah, but I mean, an understanding of what the things are that you need to be thinking about, right? That is certainly timeless and universal. As far as the actual tool that is used to capture that, that may or may not change in the future. It probably hasn't, honestly, in the last 100 years. But it may change. But even if it does, again, if you understand the right questions, if you understand what the inputs are, then regardless of what the tool is, it's something that you'll be able to use and understand. So in short, yeah, I don't expect these to change. They have certainly stood the test of time to date. But even if they do, I think more importantly, what you really learn is the foundation, right? Is the way of thinking about the questions that the tools are made to answer.
Thank you. One other question that came in is this: assuming that you master all of this and you as a brand or product or team manager understand these concepts and are able to apply them and make good decisions, do you have any advice for taking those decisions and justifying them to a senior manager who does not have this vocabulary and doesn't have this understanding?
Sure, yeah. So presentation skills are really an important thing too, and it's something I know we teach in some of the other executive education programs, and I know it's something I think we've included in sort of expanded in a 5-day version of this course in the past. But yeah, it's it's tough when you're if you're presenting to. I mean, the nice thing is that you could probably always go and present it to your boss's boss, because he likely will probably have these tool sets. But it's there's nothing here that you can't present on a high level to get somebody to understand, right? So even though your boss may not exactly know what net present value is, in a few minutes you can very easily explain to them why net present value needs to be positive, right? Because if it's not, then you're destroying value. Or why the internal rate of return needs to be above your cost of capital, because if it's not, again, you're going to be destroying value. So what these tools really do is help you make the business case. And if you have a strong business case, and of course it makes strategic sense, and you're faced with a manager who doesn't know how to understand that or support that, to be honest, I don't know, you may want to consider the firm you're working for, because I don't know if it's going to be successful in the long run.
Okay, thank you. And I think the last question that I had seen come through, and then we'll open the floor and see if there are any others, was can you just explain a little bit about the intersection of finance and accounting, if there is one?
Oh, Jenny, I'm sorry, you cut out for a second there.
Oh, I'm sorry. The question was if you can just speak briefly to the kind of intersection or relationship between finance and accounting.
Yeah, sure. And accountants sort of will likely hate this, but really I view accounting as sort of an input to finance. So accounting is often really about generating the right information for management to make decisions, right? So accounting really has to do with, and of course for complying, for tax purposes as well. The IRS has, one of the reasons accounting exists is obviously to be able to aggregate information to make decisions, but also to figure out what to pay in taxes. So so the IRS and the various other accounting bodies in the world have are very interested in the various methods of accounting. Those may differ, right? So oftentimes firms keep 2, sometimes 3 sets of books, right? They have sort of their internal management accounting systems, and then they have their sort of external reporting accounting systems. And the external reporting accounting systems are for tax purposes, and the internal are for for actually managing the firm. So those 2 aren't always the same. But really, right, what accounting does is it's looking to collect an accurate record of what has transpired in the firm. So the information you get from accounting is really, if you're lucky, sort of accurate as of today, right, or as of yesterday. Finance then really takes that information and then looks to the future and says, okay, given what's happened in the past, given how our performance has been sort of to date, A, right, how are we doing, and B, right, so it really starts to interpret the accounting information, and also then look to the future and say, okay, what can we change going forward to create more value? So again, really, it's to me, finance has really everything to do with determining value and value creation, and accounting really has more to do with record keeping, right? With keeping an accurate accounting, an accurate tally of what's transpired. Yeah, so that's and the two, right? The accounting I really view as sort of feeding, feeding into finance. is my view of it. Now, again, accountants will probably argue a different view there, but that's how I view it.
Okay, thank you so much. Any other questions? I think we addressed everything that came in, but if you have any other questions, you can send them through now. Okay, then I'm going to thank everybody for coming. I encourage you to contact me if you have any follow-up questions about some of the educational programs that we run. If you attended this session today to learn something and take that with you into your future, I hope you found it valuable. I'll send a follow-up email with a link to the recording in the next couple of days. You're welcome to share that with your colleagues, your friends, your family, and I hope that our paths will cross. Thanks so much, everybody, for attending, and have a great day.